On our Meet Your Fund Manager episode today, we have on board Vinay Sharma, Fund Manager of Nippon India Banking and Financial Services Fund. So far, leading banking have reported a strong set of numbers from the quarter gone by. Now, asset quality too seem to be improving for most of them, and therefore, there is a case building to invest in banking and financial services fund. Let's find that out from our guest today. Welcome, Vinay, on the ET Money Show. And first question, obviously, will be that banking and financial services funds have strongly rebounded, with the category average return being more than 13%. So what would be the reason and the triggers behind it?
If you ask us, we kind of think that there are 4 or 5 primary factors which are responsible for the kind of rebound that the sector has seen. Primarily, the fundamentals of sector have improved a lot in the past 2-3 years. Post the COVID crisis, there was a fear that COVID might impact the improvement that was happening in balance sheets of Indian corporates as well as Indian banking system. That hasn't happened to a large extent. Banking system balance sheet continued to improve even post COVID, and the small bit of stress that was seen in segments where banks do not really cater a lot. Similarly, Indian corporates have deleveraged over the past 5 or 6 years, and that story has continued in the last 2 years as well. These factors combined with the fact that banking valuations at the start of the cycle, again, if we are talking of the post COVID period, banking valuations were very reasonable compared to the market, and the underperformance that happened of the banking sector before this revival happened made the sector much more attractive compared to the market in terms of valuations as well. So it's a mix of all of this banking result improving consistently for the past 4 or 5 quarters, no asset quality shocks coming in the system, corporate and banking balance sheets improving consistently. And I think one technical factor that was an overhang for the sector was continuous FII selling. And as you know, banking is the largest sector in India, and whenever a large outflow happens, it's a sector that surely gets impacted every time when that happens. We have seen some slowdown in FII selling and some reversal of flows as well in the past few months. That has also helped, I think, in the performance of the sector.
Vinay, let's also talk about the growth outlook now. How does it look to you? Because considering the quarter numbers, which are good, how is this sector panning out, especially when we still have geopolitical tensions and other developed economies slipping into recession? How is this sector looking to you in terms of 2 to 3 quarters from now?
As far as sector fundamentals are concerned, we do not see a massive emerging risk to the sector fundamentals. As in, if you look at all the big segments of Indian banking system, whether it's large corporates, whether it's mid and small corporates, whether it's retail, housing loans, all these important parts of banking system are doing quite well, and we do not see a emerging risk in any of the major segments when it comes to the banking asset quality. Similarly, in terms of earnings and profitability, we are quite confident that banking large players in banking system would continue to deliver decent earning growth without asset quality shocks for some time to come. However, having said that, there are some concerns emerging on the Indian macroeconomics today, and as you know, banking is sort of a reflection of country's macroeconomy. So if large outflows were to happen from India due to any geopolitical or macroeconomic concerns, that obviously will have a impact on the sector performance as well. And the biggest risk to us in terms of Indian macroeconomy today seems to be oil price. If oil price stays at this level above 100 or around 100 for another 6, 9, 12 months, we believe that would put incremental pressure on both Indian inflation, Indian rates, as well as the trade deficit figures. And that could have some impact on this macroeconomic deterioration, can have some impact on sector fundamentals as well. But as of now, that risk seems to be, we would call it a low probability risk. And therefore, from per se sector micro or sector macro, we do not see a big risk emerging in either of the segments that we track.
Right. So talking about concerns, do you think strengthening dollar is really a concern for you?
Well, dollar strength, not so much, but the impact that it's having on most of the emerging market currencies, including India, and the fact that it's this rupee depreciation feeds into a little bit of inflation problem and interest rate trajectory. That is a bit of concern because we believe Indian rate cycle would halt only when dollar appreciation sort of slows down because until that point of time, we may have to raise interest rate just to protect the currency, and that is a bit of concern because you would want at some point of time currency stability to emerge and depreciation to slow down. Last few months, we have seen sharp depreciation in Indian currency and most of the emerging market currency. India has actually outperformed most of the currencies, but yeah, to that extent, in terms of both outflows as well as interest rate scenario, dollar strength is a little bit of a concern.
Definitely. So now, Vinay, talking about 2015, 2018 and 2020, now this sector gave poor returns. These funds are also highly risky because of the concentration that they have. So how should investors actually look at banking and financial services fund in the current juncture?
So, Gurita, that's a very difficult question to answer because, as you know, the kind of risk profile that each investor has is quite different. And sector funds or thematic funds are generally more volatile as compared to diversified funds in nature. Having said that, one should note that the opportunities in financial services industry are sort of expanding over the past few years. Like when we started managing, or when I started managing financial services fund at that point of time, the choices were limited to PSU banks, private banks, and you could maybe say one or two insurance companies. Today, that choice has expanded in last 10 years from to PSU banks, private banks, small finance banks, a plethora of NBFCs, insurance, asset management, wealth management companies, and now the new financial technology companies are emerging. So therefore, financial sector per se has become much more diversified and probably less cyclical as compared to what it used to be a few years back. Having said that, by nature, sector and thematic fund would be more volatile than diversified funds, and therefore investors have to acknowledge that risk and see whether it fits their risk profile or not. Um, Also, in terms of duration, see, equity is a longer gestation asset. We always encourage investors to invest in equity for at least a period of minimum 3 to 5 years, and that sort of is true for sector funds, thematic funds as well. Like the minimum duration of investment in equity assets should be medium term and at least 3 to 5 years.
So in this scenario, Vinay, if we talk about already well diversified funds, for example, flexi cap or large cap, they have a lot of exposure to banking already. So in order to an investor to add this kind of a sector fund in their portfolio, what should be the criteria or the parameters? Because you're already well diversified into this sector through different type of funds. The one that I mentioned, large cap, flexi cap, multi cap, almost all of these funds have exposure to this sector. So banking and financial services funds specifically, how should an investor place when already well diversified in their portfolio?
Yeah, so that's true that BFSI being the largest sector in index and in terms of market capitalization in India, it already has significant presence in most of the diversified funds, more so in large cap funds compared to flexi cap, mid cap, and small cap, probably in that order. So having said that, there are one or two peculiarities of financial services. That one, it is, as I said earlier, it is a reflection of domestic economy. Generally, Indian banks are and financial system in general is very domestic in nature. So if you want to increase your presence to domestic economy in your portfolio, financial services funds or infrastructure funds are a good way to go about it because these most of the companies in these funds tend to be anchored to domestic economy. Obviously, some part of it is dependent on commodity prices and what's happening in global economy as well, and inflows and outflows. But generally, the fundamental drivers behind most of the banking system in India is very much domestic in nature, and I think that could be one reason to for investors to look at such funds, whether it's banking or infrastructure.
Okay, talking about allotting exposure to this sector in your portfolio, how much percentage of exposure should be going into banking and financial services fund?
That depends on the risk profile and what sort of portfolio an investor is already sitting on. So, for example, if you are the slightly risk-averse investor and your portfolio is more inclined towards large cap and balanced funds, then probably adding a little bit of beta in terms of either financial services fund or infrastructure fund would be a good idea, given the cycle that Indian domestic economy is looking quite strong, and these sectors are a good reflection of what happens in Indian domestic economy. But if you are already sitting on in large part in slightly more volatile asset class such as small caps or sector funds, then probably it's not a great idea to add more beta to that sort of profile. So it depends on investors' profile, but I would generally tend to say that investors should keep sector funds or thematic funds limited to probably 20-25% of their asset allocation and not more than that.
All right, Vinay, thank you so much for participating and helping our viewers understand the future of banking financial services sector, and also explaining them as to how can they allot exposure to this particular sector in their financial portfolio.